Hey traders, Raghee here, and in this free recap video, I'm going to cover 5 of the cautions that I look for when I'm trading the open on the heels of specific events or anticipation of specific events. When I mean cautions, I don't mean that trades won't necessarily trigger. In fact, one of the most challenging things is when we have non-farm payroll, when we have FOMC meetings or minutes or chairman speaking events, end of month, end of quarter, or options expiration, any of the witchings, if you will. It's not that trades won't trigger. It's that they typically don't tend to have that crispness when they fire through a trigger, and they don't tend to have the same quality of follow through. So let me show you what I mean by that. Today, and I'm going to take you on over to one of the tools that we use on Thinkorswim. And this is the clearing range breach study that we use. We make available to all the members, a free tool. And you don't need the tool to do it. It's just marking the high and low of the first 5 minutes after the bell, the high and low the first 15 minutes after the bell, and the high and low the first 30. So that's all that it is, and this just automates it. So notice the first 30-minute breach occurs, and that happens right there. And then of course you see this happens automatically. It just gives you a heads up. And we know the trade has triggered through resistance, which is great. The problem then is, does the market follow through to the upside all that much? Now, for some folks, about 2 points to the upside is great. But when I'm trading the S&P and I'm looking for price movement, I'm actually looking for more than 2 points. So while the FOMC and on-farm payroll, witching, end of month, end of quarter, while I know there's going to be less follow through, one of the things I can do is adjust my expectations for the lower end of the price movement range, or the average, not the average to the high, which is typically what I'm looking at, the typical average price movement range. The NASDAQ fired off in a similar way. We had the nice 30-minute breach. You can see that right back in here. So we break this level right there. The breach alert triggers. And then look at the follow through. Really not, you look at about, in this case, about 19, 20 points in the NQ. That's actually not a whole heck of a lot. It would definitely be towards the lower end of the price movement range. I use a historical 60-day look back to look at the price movement ranges for any market that I'm trading. Doesn't matter if it's NASDAQ, doesn't matter if it's a stock, ETF, futures, Forex. I use the same type of study. So again, the trades will trigger through different levels, but the follow-through becomes a lot less than what we would normally expect. In fact, I think this week has really been one of those weeks where certain trades will trigger, but the follow-through has been much, much more difficult. And when you see that happening, when the structure of the market doesn't really allow for continuation, you have to know what some of those more near-term price movement range expectations can be. And that's when I'll look at, as I mentioned, the average to lower end of the price movement range based upon the time of day. So 10 o'clock, I'm looking at something around 40 points of follow through, not something closer to 65 plus. The problem is we didn't even register even the 40. So even if I'm down near the lower end of the range for the hourly price movement range, didn't even print that. That's what I mean about very low follow through. And we know that's going to come because of what event is happening. So our alternative is to adjust to a 15-minute rolling updating study of the expected price movement range, where now I get a better idea of what the range from high to low can be looking at a 30 or 15-minute expectation of movement. So this is a 15-minute projection, and this is a 30-minute projection. So that's usually a fewer number of points or pips or ticks that I'll look for follow through at. So if I'm seeing it for 10:30 to 10:45, I'm probably going to exhaust around 76.19 on the NASDAQ, and I go back and say, all right, where am I going to exhaust? I didn't even get up there. I still fell 10 points short, which really brings us back to, are there certain days where it's absolutely okay for us to, and I wanted to bring you back this note, there we go. On certain days, is it absolutely okay to just skip the clearing range trades, I think if you find by skipping out on these particular events, you're going to find a whole lot more success longer term throughout every single month, even quarter, on avoiding certain days because the follow through just won't be there. Or you really tighten in those price movement range expectations, but that's tough. You'll notice that it doesn't fall within those historical studies. So just a great thing to keep, kind of a caution, a warning. Write these dates down, have them on their calendar, circle them in red, and know that follow through is going to be affected. And I'll see you in the next update.